Here is the trap. You move to Portugal, and on your first U.S. tax return from abroad, the IRS still applies its own rules to your Social Security, your pension, and your IRA distributions, because the U.S. taxes citizens on worldwide income regardless of where they live. The exclusion you read about, the $132,900 one for 2026, only covers earned income. If you retired before you moved, it may not reduce your U.S. tax bill by a single dollar. A lot of retirees discover this at filing time, in a foreign country, when the options to undo it cost more than the move did. I am here to walk you through the real rules before that happens to you. Call me your plain English guide to the retirement decisions the ads do not bother to explain. In the next 16 minutes or so, you will know exactly which income streams the IRS taxes when you live overseas, which tools the law gives you that actually work for retirement income, and the one question you need to answer before you sign anything abroad. Here is the roadmap. First, how the U.S. taxes citizens who live abroad, because it works differently from almost every other country on earth. Second, the Foreign Earned Income Exclusion, what it covers, and, critically, what it does not. Third, your Social Security, your pension, and your IRA draws, the income most retirees actually live on, and what the IRS does with each one. Fourth, the foreign tax credit and totalization agreements, and why they are two completely different tools for two completely different problems. And fifth, the pre-move checklist that separates people who do this right from people who pay for expensive mistakes. And there is one protection that nearly everyone confuses with something else. Getting that confusion wrong can mean two governments tax the same money. That is Part 4. Stay with me. Part 1. The United States is one of the few developed countries that works this way. Most countries tax income based on where you live. Move to Spain, pay Spanish taxes. Most countries focus their tax on residence. Leave, and your obligation to them typically fades with your residency. The United States does not work that way. The U.S. taxes based on citizenship. Move to Italy, you still owe the IRS a return every April. This is called citizenship-based worldwide taxation, and it is shared by almost no other major country on earth. What this means for you, practically, is that moving abroad does not eliminate your U.S. tax obligation. It changes it. And the change, when handled correctly, can be significantly in your favor. But the first thing you need to hear is this. Any financial content that promises you can move overseas and pay zero U.S. tax on all your income is not telling you the full story. What the law actually does is more nuanced than that, and more useful. Part 2. The Foreign Earned Income Exclusion, and the part people consistently misread. The Foreign Earned Income Exclusion, or FEIE, is the centerpiece of U.S. tax law for Americans working abroad. The IRS adjusts this limit annually for inflation. For 2026, the published figure is $132,900 per person. Verify the current year amount on irs.gov before filing. You can exclude up to that amount of foreign earned income from your U.S. federal tax return. A married couple, if both spouses work abroad and both independently qualify, can together exclude roughly $265,000 in 2026. But notice, that only works if both spouses have qualifying foreign earned income. One spouse's unused exclusion does not shelter the other's pension or IRA money. That is a significant number. And here is where the misreading happens, because that word, earned, is doing a lot of heavy lifting. Here is the clearest example I can give you. If you earn $70,000 consulting remotely from Costa Rica, FEIE may help meaningfully. If you receive $70,000 from Social Security and IRA withdrawals, FEIE likely does nothing. $0 of reduction. Same dollar amount, completely different tax outcome. That distinction is the most important line in this entire video. Earned income means wages and self-employment income. It means money you are actively working for in a foreign country. If you're 58 and running a consulting practice remotely from Costa Rica, that income can potentially qualify. If you're 63 and teaching English classes in Mexico City, that income can potentially qualify. What does not qualify? Pension income, Social Security benefits, annuity payments, IRA withdrawals, rental income, dividends and interest. Every form of passive retirement income that most Americans actually live on once they stop working. None of it is earned income under the IRS definition, and none of it qualifies for the FEIE. The Foreign Earned Income Exclusion does not make your retirement income tax-free. It makes your foreign work income potentially tax-free. If you are fully retired and living overseas on Social Security and a pension, the FEIE will not reduce your tax bill by a single dollar. To use the FEIE at all, you must meet one of two tests. The physical presence test requires you to be outside the United States for at least 330 full days out of any 12 consecutive months. The bona fide residence test requires you to establish genuine, long-term residency in a foreign country, typically for an entire tax year, with real evidence that you intend to stay. You cannot just rent a beach house for the winter and claim this exclusion. Part 3. Now, here is where most retirees actually need to focus: Social Security, pensions, and IRA distributions. Let's go through each income source one by one, because the IRS treats them differently. Social Security. This is the one people worry about most when they consider moving abroad, and the good news here is real. U.S. citizens, in general, continue to receive their Social Security payments overseas via direct deposit. The Social Security Administration confirms that payments go to beneficiaries in nearly every country in the world. There are a small number of exceptions. Cuba and North Korea are the primary ones. But if you're thinking about Portugal, Panama, Mexico, Thailand, France, or most anywhere else a retiree would actually want to live, your check keeps coming. If you're thinking about Portugal, Panama, Mexico, Thailand, France, or most anywhere else a retiree would actually want to live, your check keeps coming. Now, does Social Security get taxed when you live abroad? On the U.S. side, it depends on your provisional income, the same formula that governs Social Security taxation for Americans who never leave the country. Provisional income is your modified adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. If your provisional income as a single filer stays below $25,000, none of your Social Security is federally taxable. Between $25,000 and $34,000, up to 50% can be taxed. Above $34,000, up to 85% can be taxed. These thresholds are not indexed for inflation. Congress set them in 1983 and 1993 and has never raised them since, and they are the same whether you live in Scottsdale or Lisbon. Moving abroad does not shift them. Whether your host country can also tax your U.S. Social Security benefit is a different question, and that comes down to the specific income tax treaty between the U.S. and the country where you are living. We will work through that in Part 4, because confusing those two questions is exactly how people end up thinking. A totalization agreement does something it does not do. We will get there. One practical note on payments. Check SSA's Payments Abroad screening tool before you choose a destination. Payments go to beneficiaries in nearly every country, but Cuba and North Korea are exceptions, and a handful of others have restrictions. Confirm your destination is on the clear list before you commit. Pension income, whether from an employer plan, a 401k distribution, or an IRA withdrawal, is also subject to U.S. federal income tax regardless of where you live. Living in Bali does not change what the IRS thinks of your traditional IRA withdrawal. That distribution is still ordinary income on your U.S. return. The good news is that the foreign tax credit, which we will cover in Part 4, may reduce the U.S. tax you owe on income that was already taxed by your host country, so you do not pay the same dollar to two governments. But we need to be precise. The foreign tax credit reduces your U.S. tax bill, not your foreign tax bill. The host country sets its own rate on your income. The credit makes the U.S. yield. One note on pensions from a foreign employer. If you spent part of your career working abroad and have a foreign pension from that country, the U.S. tax treatment depends on whether a treaty covers it. Some treaties provide relief. In some cases, the host country alone taxes the foreign pension, and you claim a credit or exclusion on the U.S. side. This is treaty-specific and genuinely complicated. It requires looking at the specific treaty article on pensions. Before we go to Part 4, if you have already decided on a country, or you are seriously weighing one, drop it in the comments. Say the country name, or just say, abroad. It tells me which specific treaty breakdowns to do next, and it helps people in your situation find this video. Part 4. The Foreign Tax Credit and Totalization Agreements. Two completely different tools for two completely different problems. Here is where the law actually protects you. And here is where the confusion I mentioned at the start happens, so stay with me for a moment. The foreign tax credit is a credit against your U.S. tax bill for income taxes you have already paid to a foreign government. If your host country charges you $4,000 in income tax on your pension and investment income, you may be able to reduce your U.S. tax bill by up to that amount through Form 1116. But the word "up to" matters here. The credit has limits based on which income basket applies, source of income rules, and the specific treaty provisions for your country. It is not an automatic dollar-for-dollar offset in every case. For retirement income that the FEIE does not cover, the foreign tax credit is often the next place to look. But it requires checking both the treaty and the Form 1116 limitation rules before assuming it fully eliminates double taxation. To be precise about what this does, the foreign tax credit reduces your U.S. tax liability. It does not reduce what your host country charges you. The host country sets its own rate. But what you already paid the host country may substantially reduce what you owe the IRS on the same money. And in many properly planned cases, the credit can prevent most double taxation. Here is a simple way to see how this plays out. Two retirees, same $40,000 in IRA income, same U.S. tax liability on paper. One lives in Germany, which has a substantial income tax and a U.S. treaty. The German taxes on that income may largely offset what the retiree owes the U.S. through the foreign tax credit. The retiree effectively pays one country's rates, not both. The other retiree lives in a country with no income tax at all. There is nothing to credit against the U.S. bill, so the IRS gets its full share. The tax-free haven is only tax-free from the local side. The IRS does not care where you live. This is why the country selection matters as much as the lifestyle decision. High tax with a strong treaty can be financially comparable to staying in the U.S. Low tax or no tax with no treaty can mean paying the full U.S. rate on everything. Now, totalization agreements. This is the confusion I warned you about at the start. And it matters. Totalization agreements are not income tax treaties. They do not decide whether your Social Security benefit is taxable as income. This is the mistake. People think totalization agreements stop income tax on their Social Security check. They do not. What totalization agreements do is address Social Security payroll taxes, the contributions you make while working, and the self-employment taxes. The United States has totalization agreements with 30 countries. If you're still working while living in one of those countries, you pay into one system, not two. That is their job. For retirees who are already collecting Social Security rather than contributing to it, totalization agreements help ensure benefit credits from working years in both countries are combined. They are important, but they are not what protects your Social Security benefit from being taxed as income by a foreign country. That protection, if it exists, comes from your country's specific income tax treaty with the United States. Some treaties include provisions that say the host country cannot tax your U.S. Social Security benefit, or that only the U.S. retains taxing rights over it. The exact language depends entirely on which country you are in, and many treaties contain a saving clause that lets the U.S. continue taxing its own citizens regardless of treaty provisions. This is one of the areas where a cross-border tax professional is not optional. Part 5. The pre-move checklist, and why the biggest mistake is trying to do this without the right help. Here is the framework for thinking about your tax picture if you are considering a move abroad. First, know what income you're actually retiring on. If you're living on Social Security plus IRA draws plus a pension, the FEIE is likely not your tool at all. Your lever is the foreign tax credit, and, if you're drawing from Roth accounts, the favorable treatment Roth distributions receive because they generally do not raise your U.S. provisional income. Important note here, the U.S. may treat qualified Roth withdrawals favorably, but your new country may not recognize Roth treatment the same way. That needs to be verified country by country before you decide Roth is your clean lever overseas. Second, match the country to the tax math, not just the lifestyle. Panama operates a territorial tax system that taxes only income earned inside Panama. U.S.-sourced income is generally outside its reach, though you still owe the IRS on it. Countries like France and Germany have substantial income tax treaties with the U.S. that determine how your income is treated. Portugal is the clearest cautionary tale here. For years, its non-habitual resident program drew American retirees with a low flat rate on foreign pension income. But Portugal closed that program to new applicants back in 2024, and the regime that replaced it no longer gives retirees that pension break. The glowing articles you may still find online are describing a door that has already shut. Whatever country you are considering, the treaty details and current tax regime require current, country-specific advice. Third, get a cross-border tax professional before you move, not after your first year. Before, a domestic CPA who has never filed a Form 2555 or Form 1116 is not the right person for this, and they will tell you so if they are honest. The IRS's Publication 54, Tax Guide for U.S. Citizens and Resident Aliens Abroad, is a free starting point, and it runs through these rules in detail. Use it, then find someone who does this work professionally. Fourth, keep filing U.S. returns. Living abroad does not remove the filing requirement. U.S. citizens must file a federal return if their income exceeds the applicable threshold for their filing status, and that requirement does not change based on your mailing address. Failure to file triggers penalties that can far exceed any savings the move was supposed to produce. Fifth, two traps people almost always miss. State tax. If your former state still considers you a resident, and some states are aggressive about this, you may owe state income tax even while living overseas. Confirm that your former state will accept your departure as a change of domicile before you go. And foreign bank accounts. If you open or hold accounts in a foreign bank with an aggregate value exceeding $10,000, you are required to file an FBAR. That is a report of foreign bank and financial accounts, separately from your income tax return. FATCA is a related but distinct IRS reporting rule for foreign financial assets above higher thresholds. Neither is an income tax. Both carry severe penalties for missed filings. Your cross-border professional needs to know about every foreign account you open. And here is the reframe I want to leave you with. Moving abroad is not disappearing from the IRS. It is changing which tax rules touch which dollars. And done correctly, some of those rules can work in your favor. The law gives Americans real options. Most people just never learn where to look before they pack. Closing. Let me distill this to one rule. The FEIE shelters what you work for, not what you have already earned and saved. Social Security, pensions, and IRA distributions follow you overseas. The IRS still calculates your liability just as it would in Phoenix, but the foreign tax credit may mean you're not paying two full sets of taxes on the same income. Two different tools for two completely different parts of your income picture. Get that distinction right before you move, not after. This is not financial advice or tax advice for your specific situation. What we covered today is education, and the details of your income mix, your destination country, and any applicable treaties require a qualified cross-border tax professional. But now you know the right questions to ask, and the right questions are worth something. Before you call a cross-border professional, do this first. Write down your income sources and label each one. Earned income, Social Security, pension or 401k distribution, Roth, taxable investment. That list tells you immediately which tools, FEIE or foreign tax credit or treaty, are even relevant to you. The advisor who sees that list before the meeting will give you a much more useful answer than one who has to spend the first hour sorting out what you have. If this gave you a number worth running, or a question worth bringing to a professional, drop the word abroad in the comments. It tells me this topic is useful, and it helps more people your age find content that actually explains the rules without the ads. If this was worth 16 minutes of your time, the like button genuinely helps this channel reach more people in your situation. And subscribe if you want plain English retirement and tax videos. No fairy tales, no fine print buried at the end. Retirement done right is not about where you live. It is about knowing which rules are working for you before you go. Until next time.